Hello, everyone. My name is Eric Belasco. I'm an associate professor at Montana State University in the Department of Agricultural Economics and Economics. And we're going to talk about risk management today. And we're going to talk about it in grain operations as well as in livestock operations. So just to kind of give you an outline of my talk today, first what I'm going to do is kind of start and talk about just some basics about risk management. Even if you're new to farming or ranching, some basic concepts that you'd be familiar with. And then talk about specific areas of risk management regarding price risk and production risk in grain production operations. And then also for some of our ranchers, talk about managing price risk. And we'll go into some examples, and I'll give you guys some tools to look at to help you manage those. And then also, especially if you're in a grain operation, a big way to manage risk is with crop insurance. And so I'll just briefly walk you through two of the most common crop insurance policies out there, yield protection and revenue protection. So let's get started here and start talking about the basics of risk management. So first thing, just to kind of define risk, when we think about it, risk is just basically the potential of something bad happening. So, you worry about, something happening where you can have an undesired outcome, and how do you prevent against those losses? And so there are three main examples where we can think of an undesirable outcome where, right now, even me as a university professor, these are three things that I use to try to prevent against undesirable outcomes. So first, the first undesirable outcome you can think of is just basically your house catching on fire, right? That's obviously something we'd like to prevent against. A lot of us buy insurance against that. Second, if I get into an auto accident and I might have some medical costs, or I might have some damage to my car might be totaled. And so I want to prevent against any losses that I can incur from that accident. And then third, and right now this is a really important example, which is healthcare, right? So I could, have something happen to me. I could get, sick, and I want to have some way to make sure that I don't incur high medical costs. And so, like in agriculture, these are three different areas where, we want to try to prevent against these big losses that can have sort of a long impact on our financial well-being. And so how do we prevent against these things affecting us in the long term? We buy for a house, we'll buy homeowners insurance, right? And a lot of banks, if you're going to take out a loan, they're going to require that you have some kind of homeowners insurance policy. And the way that this basically works is, as many of you know, you pay a premium every month that goes and that pays in case something happens. And if something does happen, so in the case of a fire, for example, you get an indemnity to cover your damages, right? Usually, so again, every month as part of a mortgage payment, you are paying part of that insurance. And then if a fire happens, you'll have what's called a deductible, where you'll pay, let's say the first 1,000 or the first 5,000 of your damages, and then the insurance company picks up the rest of that, okay? The second example that we talked about with auto insurance is, again, this is something that we buy, we make monthly payments, and then if we get into an accident, we receive what's called an indemnity, right? We submit a claim, we receive an indemnity. Every insurance policy has some kind of a deductible, and when we get to crop insurance, we'll talk about the deductible, and these same things will kind of come into play. These same terms, indemnity, deductible, and things like that. So with auto insurance, obviously, the higher your deductible, meaning the more you pay before the insurance company pays, the lower your premium rate is going to be. So if I have an auto insurance policy and my deductible is $500, that means I pay the first $500. And then the insurance company pays the rest if I get into an accident. If I were to lower that deductible to, say, $100, then my monthly premium would be higher, but then if I did get into an accident, I would also receive more money back. A larger indemnity would come back to me. Health insurance is no different, right? So we pay our premiums, and then after the deductible, the insurance company picks up. And insurance is a little different because there's usually a bit of a copay that happens after that deductible. But each of these three examples shows us a way that we want to, again, and we can think about this in agriculture, where we want to prevent against a single event or sort of something happening that's going to affect us in the long term financially. We can think about high medical costs. If we don't have insurance, those costs we could be paying off for years and years, right? We could be in debt paying those medical costs off for years. And so one way to prevent against that and to kind of stay in front of it is to buy insurance. So that way, if something does happen, we're not paying this thing off, for a long period of time. Same is true in agriculture, right? If we take these steps to insure against these adverse events, then again we could stay in business year after year. But the important thing to point out here is that all these insurance programs come with a premium, right? So there's a bit of we're paying a little bit of money ahead of time in order to offset some of the likelihood of something bad happening. So why would we buy insurance? Why do I buy insurance? Why in agriculture should you think about buying insurance? And I think the first one is the most important here. That is to prevent against substantial losses, right? And you might be able to cover, the cost of a premium every month or every year. But if you get hit really hard all at once, that might be a really hard thing for you to cover, okay? And so the number one reason we buy insurance is to kind of even out our consumption, even out our expenses over time, right? So we don't get hit. We have a insurance premium payment every so often, but we don't get hit by that big loss. Less worries. You sleep better at night. I'm a university faculty member. We tend to be the most risk-averse people in the world, meaning, we don't really like to take on risk. And so, just sleep better at night knowing that, if something does happen, you have insurance against it. The third thing, planning is just easier when costs are relatively constant. And so if we're thinking about, what our costs are going to be, it's just a little easier to know that if we have sort of a bottom line where our profits are going to go, where our revenue is going to go, then that makes planning a little bit easier. It also makes planning with the bank easier, right? So the bank oftentimes will force you into getting crop insurance, and the reason is because, or at least having some kind of risk management strategy, because they want to make sure that you're going to have some level of revenue, right? That's going to be adequate to pay off any operating loans you might have. So insurance risk management certainly makes planning much easier, not only in your own operation, but then also with third parties like a bank. And the fourth thing, we tend to prefer less variability when expected returns are the same. So this is kind of what economists have been looking at for a while, and we've kind of found that if you give someone kind of the same revenue over time, they're going to prefer the more stable revenue over the more volatile revenue, right? Meaning, and so if you're buying insurance, again, your revenue goes down a little bit or your costs go up a little bit because you're paying those premiums, but it also means that you're not going to get hit in any particular year. So just going to walk you through here real quick how insurance products are developed, and this should help to, I think, guide what you're paying in terms of your premium rate. So one term to talk about right off the bat is this idea of an actuarially fair rate, and that's where usually insurance companies start. So they'll collect a lot of data. If you are buying an auto policy, they'll want to know all about your driving record. They'll want to know what your age is. They'll want to know if you're a student, if you have good grades. These kind of things give them information to know what's the likelihood that you'll be in an accident, right? Or if you're buying health insurance, they might want to know what's the likelihood that you're going to incur major costs. And so they can use that to then develop some kind of an expectation of how much they're going to pay out to you in loss. I have losses here, but you can think of that as indemnities. Okay, how much is the insurance company likely to pay you in indemnities? Okay, so once they figure that out, and again, they collect a lot of information on you for that. If you're in crop insurance, we'll talk about how you turn over your production history, and they can use that to determine what your potential losses might be. That is equal to what we call the actuarially fair premium rate. So over time, if the insurance company just charged you what they expect to pay back out to you in indemnities, they wouldn't be making any money on you. They would just be smoothing out your consumption. We'll have a bit of an example about that here in a minute. So think about this kind of simple example. Say that it's likely that you'll be in an accident once every 10 years, and you don't know when that accident's going to happen. It could happen in the first year, it could happen in the 10th year. And if you do get in an accident, the cost will be $2,000, right? So this is a very simple example. We know in reality these losses are, not capped or, $2,000, but let's just say it's $2,000 and it's going to happen once every 10 years, okay? And so that's, based on what the insurance company has collected on you. So what is the actuarially fair insurance premium rate per year? So keep in mind that the insurance company is sitting there saying, okay, some point over the next 10 years, we're going to pay this customer $2,000. We don't know when it's going to be, but it's going to be sometime over the next 10 years. In addition to that, most insurance companies are going to charge a little more. They're going to charge about 20% more. It could be higher than that depending upon what insurance product you're buying. This is called a loading factor, right? And so why would they have a loading factor? It's because, if you get into an accident and you call, about your auto policy to report a claim, you have an adjuster that you're going to talk to, and that adjuster is going to then talk to, the other insurance company, the other driver. They're going to talk to the mechanic. They're going to do all this stuff, right? They're going to make sure that you were actually in an accident. They also, a lot of companies have shareholders. They need to report profits and things like that. So a lot of times, these premium rates are going to be above what the actuarially fair rate is. And so if we just kind of work these out here, we can see what the actuarially fair rate is, in this instance, is $200. So that means if the insurance company charged you $200 per year, at the end of 10 years, you would pay $2,000 to them, and then at some point over the next 10 years, they would pay you $2,000, right? So you would basically be even Steven here, right? You would have paid just as much as you would have received out. So, what would be the benefit of that? Well, you might not be able to afford that entire $2,000 hit at one time, right? So if it comes in the first year, you might not be able to afford that. When I was a college student, that $2,000, I would have spent a long time paying that off. And so really, the thing to keep in mind with all these insurance examples that we're going to go through is what are you able to pay for, and what do you need to buy insurance for? Now, in reality, that insurance company is not going to charge you $200. They're actually going to end up charging you $240 per year. And the reason for that is because they're going to have that 20% loading factor. So you're paying $240 per year. If we think about that over 10 years, you end up paying $2,400 over that amount of time. If you get into an accident, you're only getting $200 back. So the insurance company is keeping $400, right? They've made $400, and that's sort of the cost of them doing business with you, right? Because of that loading factor. So just some questions to think about. And before we start getting into agriculture, I think, again, these examples are just meant to illustrate how we should be approaching insurance and how we should be thinking about these decisions. And by the way, I'm not suggesting that insurance is always the thing to do. I think, you need to think about when is insurance appropriate and when is it not, right? So for me, like I said, I tend to be very risk averse, but still there are many times when I do not buy insurance, right? So, when I buy a $50 electronic and they offer me insurance on it, I typically say, no, that's okay. If my $50 electronic device breaks, I'll either, have to be okay with it, or I'll just buy a new one, right? So it's not always the case. But the question is, would you rather pay $240 per year than pay $2,000 at once? Can you manage that $2,000 payment? Or would you rather pay the $240 every year? Some other considerations that you can do. So maybe I should have a higher deductible, right? Maybe if I have a higher deductible, it can lower my premium rate. Maybe I'm not worried about the $2,000 hitting me. Maybe I'm worried about, hitting someone who has really high medical expenses, and I just kind of want like a catastrophic level of coverage, meaning if just the worst case scenario happens, I want to be protected, right? I don't want to go bankrupt from getting in an accident. Maybe I can just save up the $2,000, right? Maybe I already have the $2,000 saved up, and in that case, like, why would I buy insurance anyway, right? I'm just going to keep the $2,000. At the end of 10 years, I'm $400 better off, right? Because I haven't had to pay any of that stuff. So in reality, those losses aren't capped, but really you should be asking these same questions when we're thinking about insurance in agriculture. So before we get in and talk about the specific products in agriculture, let's talk about what the risk looks like in agriculture. So first thing we're going to talk about is in grain operations. And really there are two big elements of risk there, which include both price and production. So production risk, think about yield uncertainty. Think about, we don't know what the yields are going to be every year. It's kind of a fun guessing game throughout the year, but we don't quite know what our yields are going to be at the end of the year. The other area that's a major area of risk is the output price, right? You don't know what the price of wheat is going to be when harvest comes around. And because of that, we have some element of risk, right? When we're planting the wheat at the beginning of the year, we don't know what the price is going to be at the end of the year. The other area where there is also some risk is in input prices, fertilizer, fuel, etc. Those things, again, also we don't know what those costs are going to be. And while input prices, we can think about, there are some ways to manage that risk. Whether it's in forward contracting some of those products. We're really going to focus here on output price and production risk, because that's really the big area of risk between when you plant and harvest. So we'll start off with price risk. And on this graph I have two lines here. So the green line there is kind of the average Montana price for all wheat. So this includes spring wheat, winter wheat on a monthly basis. And you can see here the green line moves pretty closely with what I have, this MGEX wheat, which is the commodity that's traded on the Minneapolis Grain Exchange. So MGEX, Minneapolis Grain Exchange. And so as economists, a lot of times we use these futures contracts in order to give us an idea for what the prices are expected to be. Okay, so you can kind of approach this in a couple of different ways. You could say, well, I could come up with a forecast for it. The reason we like the futures market so much is that people who are buying your wheat are participating in that market. Speculators are participating in that market. And it tends to give us a pretty good reflection of, given the information that we have right now, what the prices are expected to be. So you can see the only difference, though, is that this isn't necessarily the price that you're going to receive for your wheat. And you can see that the green line and the gray line are not exactly the same. They do tend to move together, but not all the time. We've seen, like, for the last couple years, the Montana all wheat price has been substantially lower than the MGEX wheat price. And so we call that element basis risk there. And so that's just the fact that we have this exchange out there, and that's not going to be the price that you receive. But a lot of the things that we'll talk about are going to be based off of this MGEX wheat price that we can observe over time. Historical volatility is another measure that we use, and so this is just one indicator that tells us how much uncertainty is in the market. Okay, so this doesn't tell us whether prices are moving up or down. It just tells us that prices are moving around a lot. So when this measure is high, like it was in 2008, 2009, and again recently, you see these, when you see these spikes in historical volatility, those are times when the price is moving quite a bit. And again, it doesn't mean that it's moving up or down. It just means that it could actually be in the same place. It could go up and then down, right? But it does tell us that there's just some uncertainty in the market. And so you can see the average wheat volatility has been, a little over 20%. So 0.2 puts us at 20%. It's a little over 20%, about 25%. And that's kind of where it is historically. You can see there are obviously periods above it and below it. Right now we're pretty close to it, but we just got out of a period where it was much higher. Okay, and there are really two measures. I'm not going to spend too much time talking about these, but these are really two things that you'll hear people talking about when they talk about volatility. The first one is called implied volatility, and that's when you look forward. That's the volatility that people are assuming in options that they're buying. The other one is historical volatility, which just tells us how much prices are moving. Bottom line is these two mostly move together. Sometimes they don't, but for the most part they move together. In general, higher volatility just means big price movements are more likely, or big price movements have been occurring with more regularity. And so the final element that I'm going to talk about is this idea of the basis price. And you probably all heard of this. But for those of you who haven't, we have, again, that exchange price, the MGX price, the price from the Minneapolis Grain Exchange that's traded based on national wheat prices. And then you also have the price that you're going to get right here in Montana. The difference between those is called the basis price. And so you can see here, the basis in Montana tends to be negative. Depending on where you are, it could be more or less negative. There were some periods when it was positive. Right now, like I said earlier, for the last couple of years, it's been pretty negative. But that is just kind of your adjustment from the MGX price into the price that you actually receive. And so why are those out prices so uncertain? And so, as an economist, we look at a lot of these things throughout the year. The things that really drive the price that you receive is the fact that a lot of this, especially in wheat markets, particularly over the last 10 years, has been that global supplies are unknown. So you don't know what the supplies are going to be in some of our competitor countries, right? Wheat in the Ukraine, wheat in Russia, wheat in some of these other countries that compete with us. And until we know what those supplies look like, that impacts our domestic wheat price, right? Because we are in a global market. We export a lot of our wheat to other countries. Domestic supplies as well, right? So, right now what we're finding is yields are pretty good in most areas, and which you might think, well, that's a good thing, right? But what that also means is that there's a lot of wheat that's going to be grown. And if everyone has a high yield, then that usually means the price is going to come down, right? That's the consumer saying that's too much. We're going to give you a bit of a discount on that wheat. And so that tends to depress prices. Domestic demand is unknown. So for wheat products, global demand is unknown. How much are we going to be able to export into other countries? And then fourth, and really a big area of uncertainty, is that basis is unknown. So we don't know what the local supplies are going to be like in Montana. So some different ways that we can think about managing that price risk, because again, when we put the seed in the ground, we don't know what the price is going to be when we take the wheat out of the ground. And so, there are really 5 main ways that we can manage price risk. First one, we could use storage, right? We could wait until prices go up, right? That carries with it some additional risks, but that's certainly one thing that we could do to manage price risk. Second thing is diversify, right? So we could have some things. A lot of people have been growing peas and lentils, for example. Those prices tend to be pretty uncorrelated with wheat prices, so that's a good way of diversifying. Or we can think of wheat and cattle traditionally have been a good diversification, just because, again, just because the price of wheat is down, it's uncorrelated with the cattle price. So we can diversify in those different ways to manage price risk. Third, forward contract with an elevator, right? So when we put the seed in the ground, or maybe partway through the year, we call up an elevator and we say, hey, I got 5,000 bushels coming for you. What's the price? And kind of lock in that price. Fourth thing you can do, and by the way, that will be the price that you get, right? If you receive your product. Fourth, futures contracts. You can take out what's called a short hedge, which is basically you're taking a position in the futures market that is betting that prices are going to drop, and even though I use the word betting, it's actually minimizing your risk because you're taking the opposite side of the market that you're on. Meaning, if the price falls, you're going to sell your wheat for less, but you're going to have a futures contract that's going to be worth more. Or in the other case, wheat prices go up, you sell your wheat for more money now, but then you have a contract that's worth less. So you have a contract that's going to offset your gains or losses. So in that way, it's not really betting. It's a risk management tool that you can use. And the other is a put option, which I won't get into too much, but essentially that allows you to establish a price floor. And then if prices go up, you can benefit from that. So those are kind of the 5 main ways to manage grain price risk. I mentioned this MGEX price, and this is kind of what, if you go to MGEX's website, you'll see some of these quotes, and you'll see that these contracts are sold on different months. There's different prices that they're sold for. So there's, the last price was the last transaction. They're sold December, March, May, July, September. And you have a lot of people who are in this market coming in different areas. So each of those contracts, so the contracts that I just showed you, if you go and say, okay, I want to buy a short hedge, then recognize you're essentially buying 5,000 bushels in a contract that's going to be due in a certain month. So what you'd ideally want to do is line up your contract month with when you are going to harvest. So if you're harvesting in September, you might want to have that contract due in September, or if it's in November, then you'd want a December due date. They're all reported in cents per bushel, and they make some assumptions. So they're all standardized contracts. Now, one thing to keep in mind, it might scare you a bit to know that you have some different participants in the futures market. Hedgers, just like you, if you were a farmer going in there to hedge. You also have speculators, right? So me, I could say, you know what? I think the wheat price is going to go up over the next 3 months. I'm going to go into the market. I'm going to take what's called a long position, and I'm going to see if I can make some money out of this. Which would be fine, right? Because you're going in as a hedger. I'm taking the other side of the contract. I'm trying to make money. You're trying to hedge. But the good news is that the more people who are in this market, the better it reflects the actual market conditions. So the more the market moves to the actual market conditions. And again, why we like it is it provides sort of the best guess on what the future price is going to be, because you do have people with money involved. The important thing to note is that basis is not included in those transactions. So you are taking on basis risk with that. So how can we estimate? So again, if you're planting the seed and you're trying to figure out, okay, how do I predict the local price that I'm going to get? You can use the futures market to obtain the MGX price prediction. You can obtain some information on recent basis, and then you can add those two together. Another great tool out of MSU is the wheat basis tool that Montana State has developed, if you do want any link to that, please send me an email and I'll connect you with that. But that's also a good way to you don't have to go to these different places to find that information. It'll provide it for you. So that's a lot on price risk and how to manage it. Again, the 5 different ways. Now we'll start talking about production risk a little bit. So production risk, and I have some examples here. Here we have spring wheat yields from 1970 to 2016. I took 2 ag districts in the central and north central regions. And as you can see, the average is around 27 bushels per acre, but there's rarely a year where it is exactly 27 bushels per year. It's above it, it's below it, it's moving all over the place, right? And these, by the way, are aggregated over a district. If we looked at an individual farm, that variance would be even more, right? So there's a lot of variability in yields. And so just to run through a quick example of what this might look like. So assume, and I'm recognizing now this price would be great. If you could get a cash price of $7 in wheat, you'd be sitting pretty. Might need to update this example. But we have kind of 3 different levels of yield. So, say we expect 30 bushels per acre, but we could have a low yield year or a high yield year. So it can be 20 bushels or 40 bushels per year. And whether we have a low yield or a high yield. So again, this is assuming that price risk isn't even an issue, right? We already locked in our price. Let's say we entered into a forward contract, and if you can get a forward contract for $7 right now, I would do it. Probably can't, but let's say you were able to do that, right? So we're taking price risk out of the equation, and just looking at what our revenue is per acre. And we can see here, if we're getting 20 bushels per acre, so that low yield scenario, or I'm sorry, not one, over 100 acres, then our revenue is $14,000. We see the difference between that and the medium yield, right? We're $7,000 off our revenue, and that's just 100 acres right there. So you can see how yields can also be a pretty big driver in profit risk or profit variability, okay, whether we have low, medium, or high yields. And so how do we manage our yield risk? One way is to diversify. Again, that becomes a little more difficult than with prices, because you might think, well, yeah, peas and lentils, right? But if you're in the same area, if those same risks, right? If dry weather is going to impact one crop, a lot of times it's going to affect another crop. So thinking about how can you diversify crops where if yields are going to be low on one, they won't be low on the other. The second area is with crop insurance, and we'll kind of talk about that not in the next hour. I promise I won't take that long. But essentially, what we're trying to do is establish a minimum floor for yields or revenue, depending upon what you're purchasing. So we'll get into that in part 4. The next thing I want to talk about is price risk for livestock operations. And so you might ask yourself, well, why aren't we talking about production risk? And I think ranches tend to control this risk a little bit better. There are price risk tends to be the main concern, right? The fact that when you are sitting there 6 months out from selling your cattle, you don't know what that price is going to be. And every year when I'm out talking to different groups, I always have people come up and say, oh, I'm waiting this year to get into a contract, or I got into a contract a little early. It's always sort of a game of trying to figure out, okay, is it too early? Is it too late? When's the best time to market your cattle? And so what we're going to talk about here is not, how to make the most money on that, but really how to eliminate sort of the downside to risk in your cattle operation. So again, 3 main areas of risk. Output price is by far the largest. Input cost is also a very big one, right? We can think about the cost of hay, the availability of hay as being a big area of concern. And then third, if we want to think about production risk, we can think about weight gain rates. Although animals tend to be a lot more resilient to weather than commodities, row crops especially. But we can think about like mortality rates and things like that if we do get hit by a stray storm or something like that. So here we have, similar to with the grain markets, we have this, what I have is the CME feeder price, which is the Chicago Mercantile Exchange. So this is not in Minneapolis, like the grain price or like the wheat price. This is on a much larger exchange, the Chicago Mercantile Exchange. And they have feeder cattle contracts as well as fed cattle contracts, but we focus on feeder cattle. And you can see here, if we take the 600 to 700 steer price in Montana, the green bar is almost always different than the blue bar. There's always some amount of basis. Particularly in the last couple years, there's been a favorable basis, meaning the price in Montana is higher than it is nationally. And that's just been because we have grass still growing. This last year we certainly entered into some drought territory, but before that, the animals that were coming out of Montana came with them a pretty good premium relative to the rest of the country. So again, we have these same measures of volatility. Volatility in the cattle market seems to be a little bit lower, with an average volatility of around 13% or so. And there is, again, an amount of basis depending upon your weight, and there's also some seasonal components to basis. But even when you take that out, you can see here, so this plot, I'm usually trying to figure out patterns, and it's hard for me to determine a pattern here. This is after we take out that basis component. You're really dealing with a bit of randomness in there. But you can see the magnitude of change on the basis side. It's really relatively small to the magnitude of change that you can see in the overall price. Okay, so that overall price, we can get information here if you go to the CME Group website, and they have a bunch of commodities. Two of them are the cattle commodities that they sell. And so here, and this was just in October, I downloaded this. There are contracts. If you're selling in spring, you might look at that May contract and say, okay, 150. 150 is a national price. Adjust to the Montana basis to get an actual price that I might be expecting. You can also look at the volume there. Under the volume column, you see, for those November contracts, November tends to be a pretty popular month for feeder contracts, 5,832. So that means on a daily basis, that's the amount of transactions that are being made. Again, that's a good thing because it helps the market reflect the market conditions, the more people that are participating in the market. One tool that I really like to use, so rather than trying to figure out, well, what's the basis in my area for this month or blah, 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 you can go to beefbasis.com, and they have a tool here where you can put in, and you don't have a whole lot of options in Montana. You have to, if you're selling at the Billings yard here, and what I did was I just put a steer pen or steer, let's see, 100 head, averaging 625 pounds, and I was going to sell them May 15th, so we're doing a spring sale here, 625 pounds. What is my expected price going to be? And what I like about this is it will tell you that you see where that says feeder cattle basis results at the bottom. It gives you not only an expectation for the cash price, so there it says $628 per hundredweight is the price that they're assuming, but then they also give you a confidence interval of 623 to 633. Now, that doesn't mean that that's going to be the price, right? The price could be much different than that. The price could be outside of that range. That's just saying with the information we have right now, that is sort of the price that we would expect. So things to consider in each of these. Again, we've talked about kind of where risk comes from in grain operations. We're mainly talking about controlling price risk, and we can do that in a few different ways, and production risk. Right, production risk. We'll talk about crop insurance. Production risk it's a great way to cover it through crop insurance. Price risk, you can think of forward contracts, futures contracts, things like that. Same is true for livestock, ranchers. Managing that price risk is really the main component there. And so how do we manage that? Well, we manage it through forward contracting is a really common thing, although you also can play, you can try the futures market to manage that risk as well. And if you're at all interested, sort of the advanced topic is the use of options, use of put options. And if anyone's interested in that, I'll put my email at the end. I'd be happy to talk with you about those as well. So just some things to consider, again, relating it back to what we talked about in the very beginning. First, what is your main source of risk, right? Is it price? Is it production? Is it labor? What are your main elements of risk? And how can you cover those? Are you willing to cover the losses that you might receive from those areas of risk? right? So you might be very well diversified. You might have a bunch of different crops. So maybe price risk isn't a concern, but maybe yield risk is a concern, right? Maybe revenue risk is your concern. So trying to figure out what is my risk, and then how can I cover that? There might be some risks that you'd say, well, you know what, that's a small element of risk. I can cover that. That $2,000 payment on the auto policy, like I can cover that. I don't want to pay extra money to cover that. Are you willing to pay some amount to eliminate the possibility of those big losses, right? So, think about the same reason you buy insurance in other areas of your life. Are you willing to do that in insurance? So am I willing to pay some amount of money in order to offset those losses? Now, when we talk about crop insurance, the thing that's going to be different is that instead of a loading factor, there's going to be a subsidy attached to it. So actually, over time, you will pay less than you receive in crop insurance, meaning you will receive more in indemnities than you pay in premiums over a long time horizon, right? That might not happen. You might buy crop insurance in the first couple years. Maybe you're just paying premiums and there are no indemnities. That's actually a good thing, right? You haven't experienced any losses. But over time, you should expect to get your money back in crop insurance. So with that, let's move forward to a couple different crop insurance options. And again, these are things, if you go to your bank and you're trying to get a loan, your bank might require you to get some of these. And I think you'll see why. It really allows them to have some assurances for what you're going to be bringing in. So first, talk a little bit about what crop insurance is. And, like most policies that we have in the U.S., they started, during the Great Depression, the Dust Bowl. In the 1980s, federal crop insurance expanded into more crops and regions, and really with the 2000 Farm Bill became a huge expansion of programs into different areas. One way that the RMA found that they could expand participation was to subsidize these products to around 60% or so. Historically, major grains have been big participants in these programs. So, types of insurance, the ones we're going to talk about, yield-based and revenue-based. So yield-based, you're basically insuring against low yields. Okay, so you're just insuring against production risk. Revenue-based, you insure against production and price risk, the product of the two. So you're not insuring against any individually, but you're insuring the product of the two. And we'll go through an example of just what that means. Those are both called individual plans, meaning that you report your own yield information, and that's used to determine whether you get an indemnity or not. The other thing you can do is called group insurance, which is based on county level areas, but those are not purchased too much, so I'm not going to go into those, but they are a lot cheaper than the individual policies. So let's talk about yield protection. APH you establish on each insurable unit, so that's just basically collecting your history. A lot of times you want to have at least 4 years of history in order to establish an APH. And again, the insurance company is going to use that to determine your guarantee level. So you got to have that consecutive, and at most start with the most recent year. So just here's an example. We have two producers, producer 1, producer 2. Producer 2 has been in business for 10 years. They've been keeping records, right? Every year they have their APH listed there, or their yield, sorry. And so their APH is really just going to be the average of those 10 years. So that's producer 2. Producer 1, you'll see, has only 4 years of history, right? Which is fine. 4 years is all you need. And again, you take the average of that, their APH yield will be 36. So even though in those given years, you'll notice producer 1 and producer 2 had the same yields, producer 2 has a higher APH because they've demonstrated some higher yields in those earlier years. If you do have records left for less than 4 years, and a lot of farmers who are just getting started, that is certainly the case, you use what's called the transition yield, T yield. So it allows you to transition into the program. Just remember, a T yield is basically a way for you to kind of, without 4 years of history, to use. Usually it's about a county level average. So the insurance company doesn't know what you're capable of, but they'll say, we'll assume you're about the county average until we get more information. Okay. If you're unable to supply any information, then they'll basically give you a low guarantee. Again, most insurance companies, if they don't have information on you, are going to assume the worst, and that's kind of what they do here. So as you get more information, your guarantee improves a bit. And just here are some other scenarios where if you have 2 years or 3 years, you get some of that T yield. New producers, are those who have produced a crop in a county for 2 years or less. And there are certainly ways, and I think the RMA is making a big push to get more people involved, especially new and beginning farmers, to get in there. If you do have questions about this, your crop insurance agents are really good people to talk to about what your guarantee is going to be. But record keeping is certainly an important part of the crop insurance program. And so let's say you want to get yield protection. How do you go about it? First thing you need to do is you need to have an established APH. So again, that's just your history. You decide on the unit designation. So do you want to, if you have a bunch of fields, do you want to group those fields together and insure them all together? Do you want to insure them individually? The more you aggregate, the lower the cost is of your insurance typically. And then the last thing you do, the third thing that you do is you determine a coverage level. And this is similar to a deductible level, right? So the higher this coverage level is, the lower the deductible is. And so we can choose that anywhere from 50 to 75, or in some areas it's 85% of your APH. And we'll talk about how that runs into play here in a minute. The premium is equal to the maximum indemnity multiplied by the premium rate that the RMA has determined for your area. So let's just run through a quick example here. Let's take the spring wheat example. We have a producer with an established APH yield of 50 bushels, so that's the average of their history. And they've elected to have a coverage level of 70%. Okay, and so what that means is that they have a yield guarantee of 35 bushels. Okay, so take that 50, 70% of 50 bushels is 35. Essentially what that means is that if their actual yields come in lower than 35, they'll be compensated for that amount, right? So if their actual yields come in at 30 bushels, then they'll get compensated for 5 bushels. And the RMA is not going to send you 5 bushels per acre, right? What they're going to do is they're going to write you a check for the value of that amount. And so how do they determine that value? They use this MGEX price, right? So they have a formula. They go back usually right before you buy the contract. So this would be in February. They're looking at the price for a September contract on MGEX. And for last year, that was $513. So they established that price. That's the price that you have, and that's how they value that. Now that price might change, but that's kind of the price that they establish. And so what is your maximum indemnity? The maximum indemnity, or the liability, it's also known as a liability, is basically what if your yields are 0, right? If it's a complete loss, then what's the value of that crop? So if we take 35, which is your yield guarantee, multiply it by the projected price, it's 180, so that's 180 per acre. Okay, and if we take that 180 and let's say RMA's estimated your premium rate to be around 6%, then your premium is going to be $10.80 per acre. Okay. Okay, so you will pay that $10.80 per acre. So here, and then if you have a loss, you'll receive an indemnity based on that. So suppose when it comes time to harvest, you have 25 bushels per acre, and then just here are some questions. Will you receive an indemnity? If so, calculate the indemnity. Calculate the indemnity in bushels per acre and dollars per acre. So keep in mind that your guarantee was 35 bushels and that the RMA projected price is $513. Okay. So with that in mind, you would receive an indemnity payment because your actual was lower than the guarantee. You would receive 10 bushels per acre, but again, RMA is not going to send you a bunch of wheat. They're going to send you a check. And so what do? They take that 10 bushels, they value it at the projected price of $513, and they send you a check for $51.30 per acre. Okay. So that's one way to insure against low yields. A couple things to keep in mind here. I'll just mention quickly. Trend adjusted APH is available really since 2013. It's been available in most Montana counties. It basically just allows you to get a higher yield guarantee. It assumes that there is a trend in these products, and you'll see here in 2013 it was available in just about every Montana county. And just the way it works is it just increases your yield. I don't need to go through these details, and your crop insurance agent can certainly help you with this. But the basic idea is that it accounts for a trend in yields, and it allows you to achieve a higher guarantee. So here you can see the using the trend adjusted yield, the APH is 34 bushels, whereas without it, it's 32.9. Okay, so it allows you to increase your guarantee. And so here are just some in 2013. Here are some of the adjustment factors that they accounted for there. So yield protection, again, allows us to protect against lower than normal yields. The last thing we're going to get into is called revenue protection. Revenue protection is by far the most commonly purchased insurance policy. And the reason that people like it is because it ensures both prices and prices and yields together, right? It ensures revenue. So you might have an instance where, let's say your yields are just fine, but let's say the price drops. That could be a problem for you, right? So a revenue protection would allow you to still collect an indemnity in that scenario. So, the reason that I think it works better is you have, it covers weather-related causes in terms of lost yields and price fluctuations, right? So it covers both of those things. More closely aligns with economic conditions. So really, yields is not the ultimate indicator for you. If it is revenue, and I suspect it normally is, revenue protection just more closely aligns with what you ultimately want to insure. And they had this harvest price, and they've changed the wording on it. It's not harvest price exclusion. It's now just it's included in the revenue protection product, and we'll talk about how that works. But that also makes it a nice product. You can exclude from it, but most people do not exclude from the harvest price component. So here's just an example. So again, we're using RP. It's the same farmer. Again, prices are good. We're in a good price environment here. I think it was $7.40 was the price a few years back. So our APH is 50, and so we have basically two scenarios. Same farm. And let's assume the projected price, again, the projected price is established at planting. And let's say between planting and harvest, the price changed, right? So in scenario one, the price goes up, right? So the price goes up from $7.40 to $9. In scenario two, the price goes down, okay? Coverage level, we're assuming 75% for both of these scenarios. And so you can see here what our guarantees are. The projected guarantee, again, that's at planting. Under scenario one, $277.50. That is our revenue, right? So again, our guarantee is not a yield, it's going to be a revenue. You'll notice that as the price goes up in that scenario one, the guarantee also goes up, right? So you purchased a product that had a guarantee of $277.50, but across the season, when you got to fall, the price went up and your guarantee went up as well. So now your guarantee is $337.50, right? You might think, the reason for that is because if you have a forward contract and you're short in wheat, they don't care that the price has gone up, right? They're going to say, okay, well, just, you can buy, wheat at $9 from us. And you're going to say, well, I have this yield policy that guarantees me $7.40, but that's not what you're asking me for, okay? So it makes it more consistent. A lot of people we'll use the revenue protection policy along with a forward contract, and it seems very compatible to do that. You'll notice in scenario 2 where the price dropped, the guarantee stays the same. So your guarantee is not going to drop. It's going to take the higher guarantee of the two. So if the price drops, your guarantee stays the same. Okay. So now one more element here. Let's assume our yields can either be average or below average. So here under scenario 1, yields are at 50. And so you can see there our actual revenue is 450. So our actual revenue is 450. And we get that from taking 50, a yield of 50 times the $9 harvest price. Okay, we get 450. That is above our harvest guarantee, and so we collect no indemnity. If our yields go down to 30, you'll notice that our actual revenue is 270, and our guarantee is 337.50. Right? You'll notice our projected guarantee would have been just slightly above our actual, but because our guarantee went up, now we collect that full indemnity. In the scenario where the prices decrease, yields are at 50, we're at 300, and yields are at 30, we're at 180. So we can see what our indemnity is. We collect an indemnity in both instances, basically when yields fall. You'll notice that in scenario 2, not only is the price falling, but also the yields are falling, right? So the indemnity is going to be much larger than in scenario 1. Scenario 1, it's interesting to note that your revenue is still higher, or it's about where you were projected to be at the beginning of the year, right? Your projected guarantee was 277.50, but your actual revenue was 270. But you're going to get an indemnity of 67.50, and the reason for that is because your guarantee has increased, and that's an important aspect of the RP, and I think that is what really drives a lot of people to purchase the revenue protection policy. It is the most expensive, but it does give you sort of the best coverage. We just recently had a survey that looked at what risk management practices people are doing, especially in the Midwest, and the dominant strategy was revenue protection, so buying this product along with a forward contract, right? So you buy this crop insurance product, but then you also have a forward contract with your grain elevator. With that in mind, just kind of to review, we've talked about grain operations, the price risks they face, the production risks they face. In ranch operations, price risk, how to manage some of those things. We talked about some crop insurance programs. And really, again, just to kind of review, here I think are the questions that you should be asking in developing a risk management strategy. First, identify what your main sources of risks are, right? We might not have even covered them here. If you're in a small specialty crop operation, maybe your big source of risk is labor, making sure you have people there, right? And that's not something that we talked about, but thinking about what are your main areas of risk. If it's price, you have some tools to take on that. If it's production, we've talked about crop insurance and some different ways to cover that as well. So identifying your main source is the first step. Second step, think about if you're willing and able to cover those losses, right? If a bad year happens, are you able to cover those losses? So maybe you have a small farm operation, but you're combining it with some other things, and maybe you'll be okay if you have a bad year. Maybe you have enough in savings to kind of weather that bad year. But maybe you're taking out some loans that you need to make sure you pay off, and maybe the bank is asking you to take out some crop insurance. So thinking about those things. To add to what we've talked about before, the fourth thing, think about coverage level and the cost of insurance, okay? Just like in your auto insurance policy, where I said earlier, you get a lower deductible, that means a higher premium rate. You can do the same with crop insurance. If we take out a higher coverage level, right, or a lower deductible, higher coverage level, higher premium, okay? And so if we want to get a lower cost, if we look at that revenue protection and we just say, man, that is expensive, you can always go for a lower coverage level and that's going to allow you to pay a lower premium for that. But then also weighing that with what does your sort of price floor need to be? What does your minimum revenue need to be? And then last, thinking about single or multiple peril insurance. So a lot of people I talk to, if they're just worried about hail, they buy hail insurance, right? Multiple peril, the yield protection and revenue protection policies that I talked about here, they have to do exclusively with every type of risk imaginable, right? If you read the documents, it'll include even volcanic, disturbances, right? So you're covered from everything, and so it doesn't matter what the cause was, as long as you've documented it and you have a loss, you're covered. Alternatively, if you're really not worried about those, then a lot of times you're paying extra to insure stuff that you don't need to insure, right? If you're not worried about those things. So thinking about those 5 areas, I think, is an important way to get started on developing a solid risk management strategy. If you have any questions, here's my email address, eric.belasco@montana.edu. My office phone number, 994-3706. Give me a call. I'm happy to talk. And if you want to talk about what a put option is and how you could use that, be happy to talk to you about that as well. So thank you so much, and I look forward to hearing from you. Bye.